You're seeing huge RV discounts because dealers are panicking, their lots are packed, their floor plan bills are climbing, and the clock is ticking every single month. Oversupply turned inventory into debt, and debt turns into desperation. Let's break down what started this and what happens before 2026. The production debt that went wrong. Dealers are being crushed because manufacturers flooded the market after the pandemic surge and never hit the brakes. In 2021, factories treated emergency demand like permanent demand. Production schedules doubled, supplier contracts locked, and shipments kept coming. Even as retail orders slowed, industry shipment data shows hundreds of thousands more RVs shipped than sold within 12 months. That excess did not vanish. It landed on dealer lots. Those units arrived financed, not owned. Every unsold trailer became a monthly interest bill. Dealers who expected 30-day turns suddenly faced 9-month aging. Floor plan statements grew while foot traffic thinned. The oversupply removed pricing power overnight. Discounts became mandatory just to create calls, destroying margin and trust. At the same time, the miscalculation was timing. Buyers pulled future purchases forward, then disappear. Factories mistook that spike for a new baseline. At the time order cancellations rose, production pipelines were already full. Shutting down lines cost more than shipping units out. Dealers did not request this volume, they inherited it. And once oversupply hit critical mass, survival replaced growth. What followed was not a slowdown, but a dealer death spiral underway. Now let's talk about how inventory turns toxic. Inventory turns into debt. Once oversupply locks in, inventory stops being merchandise and becomes debt. Dealers finance most RVs through floor plan loans that accrue interest every month. With aging units, those charges compound fast. At $700 per unit monthly, lot holding 50 unsold rigs leads thousands before a single sale closes. Storage adds pressure. Overflow units get parked off-site, moved between locations, or stored seasonally. Transport, insurance, and handling costs stack quietly. None of that improves value. It only deepens exposure. To slow the bleeding, dealers slash prices. Cuts of 20 to 30% off invoice are no longer rare. They're required to move metal. This math destroys confidence. Buyers learn to wait. Every discount trains the next customer to ask for more. Gross margins collapse. Cash flow tightens. Aging reports lengthen. Dealers begin choosing which bills get bid first. Lenders see the pattern before the public does. Floor plan audits flag slow turns. Credit committees question exposure. Limits get reviewed. Terms tighten. What began as excess inventory becomes a balance sheet problem. At this stage, the threat is not unsold RVs. It is revoked credit. When lenders blink, the dealer clock starts ticking. That pressure pushes crisis. If this breakdown is helping you see what dealers are saying, hit like so others find it, subscribe for upcoming updates, and share your thoughts below. Financing breaks the buyer side. When financing breaks, demand does not fade, it disappears. Loan approvals tighten fast as prices rose and risk models updated. Down payments climbed, terms shortened, monthly payments cross limits. Households will not exceed. A payment that jumps by several $100s ends the conversation instantly. Credit profiles matter more now. Minor blemishes trigger declines. Co-signers are listed more often. Proof of income rules harden. Sales staff watch applications stall that once cleared easily. The buyer pool shrinks in weeks, not years. This sudden stop fools dealers. Traffic appears normal until approvals fail. Phones ring, test drives happen, then silence. Unsold inventory ages faster because qualified buyers vanish. Promotions cannot fix qualification math. The damage here is speed. Demand collapses before pricing can adjust. Dealers discount until vaxing. Every failed application adds cost without revenue. Cash reserves thin. This shift reshapes the market permanently. Buyers who step away do not rush back. They wait for stability, not sales. When financing stops working at scale, volume breaks completely. That break forces dealers into triage mode, choosing survival moves instead of growth plans. And that pressure pushes the next decision, one that quietly changes which brands remain on the lot today. Dealers start rucking quietly. Dealer exits begin quietly because announcing retreat kills leverage. The first signal is refusal. Orders get delayed. Allocations declined. New model years script. Dealers reduce exposure without headlines. Brand choices narrow. Lines that generate warranty friction or slow parts response lose priority. Floor space gets reassigned. Remaining units sell through without replacement. Customers notice dinner options without understanding why. Footprints shrink next. Multi-location groups consolidate inventory into fewer stores. Marginal locations close through leased exploration. Service departments focus on profitable brands. Others wait longer. These moves matter because distribution is power. When dealers step back, manufacturers lose control of pricing and messaging. Marketing cannot override empty lots. Incentives fail without floor space. The collapse accelerates here. Factories depend on dealer throughput. When channels clock, production forecasts break again. Units stack at yards. Cash flow tightens upstream. This is the point of no return. Once dealers start walking, the system cannot be forced back together. Relationships fracture. Support thins. Buyers face fewer options and weaker coverage. What follows is not recovery, but sorting. Strong networks survive, weak ones disappear, but market heads toward a smaller footprint by 2026, with fewer dealers deciding which brands live or die. Luxury pricing. Without luxury demand, high-end RV pricing broke when manufacturers assumed prestige buyers were immune to math. Before the surge, a flagship travel trailer that listed around $90,000 had a clear audience. After 2021, that same unit crossed $130,000 with only cosmetic upgrades. Diesel motorhomes that once topped out near $250,000 pushed beyond $350,000. The buyer pool did not expand with those numbers. Advanced households that could once justify premium purchases were already saturated. Many bought during the surge. Others shifted money toward homes, healthcare, or investments that actually held value. The remaining buyers looked at size, reliability, and running costs, not brand badges. Prestige stopped compensating for price creep. Manufacturers misread loyalty as elasticity. They assumed buyers would stretch because they always had. Instead, buyers stepped back. Listings lingered. High-end lots became static displays. The message was clear. Luxury demand has limits, and those limits were crossed quietly. That pricing misfire fed directly into the next mistake, where scale stopped helping and started hurting. Volume became a liability. Mass production only works when output matches exits. During the surge, manufacturers celebrated unit counts, not sell-through. Plants that built 70,000 units annually were pushed past 100,000. Components were ordered in bulk. Labor was locked in. The problem appeared after demand slowed. Units kept coming while sales stalled. Slowing production sounds simple. It is not. Parts pipelines run months ahead. Suppliers demand volume commitments. Labor contracts resist sudden cuts. When factories tried to ease off, they faced penalties, layoffs, and idle equipment costs that rivaled continued production losses. The result was margin collapse. Units built but unsold tied up cash. Storage yards filled. Transportation costs rose. Selling at discounts became cheaper than holding. Volume stopped being leverage and became exposure. Factories found themselves trapped by their own systems. The very scale that once lowered costs now magnified losses. And while production kept bleeding, another issue surfaced that would not show up until much later. That delayed consequence arrived through service bays rather than sales lots. Quality damage shows up late. Rushed production always sends the bill later. During the surge, speed beat scrutiny. New hires replaced experienced builders. Inspection times shrink. Components changed without long-term testing. The defects did not appear immediately. They surfaced months after delivery. Common failures clustered. Roof seals failed early. Slide mechanisms bound or leaked electrical systems through intermittent faults. None of these issues were catastrophic alone. Together, they overwhelmed service departments. Repair backlogs stretched from weeks to months. Dealers carried the burden. Warranty labor rates rarely covered real time spent. Parts shortages delayed fixes. Customers waited, while payments continued. Frustration turned into cancellations and chargebacks. The real cost landed on dealers. Repairs tied up bays that could have handled profitable work. Some fixes went unpaid as claims aged out or were disputed. Quality shortcuts upstream converted into downstream losses. At that point, patience ran out. Dealers who absorbed the damage long enough began to respond differently. That response marked the first real shift in power across the channel. Middle-class access disappears. RV ownership did not fade gradually. It hit a wall. Monthly payments crossed thresholds that budgets could not bend around. A travel trailer that once carried a payment near $400 a month now pushes 700 or more with taxes and fees included. That change alone removed millions of households from eligibility. It was not about desire, it was arithmetic. Household budgets have fixed breakpoints: mortgage, food, insurance, fuel. When a discretionary purchase jumps by several $100s a month, it simply drops out of reach. No negotiation fixes that. Promotions do not change it. Manufacturers assumed buyers would stretch. Instead, buyers walked. Sales data shows abrupt drop-offs, not slow declines. Once payment quotes crossed those breakpoints, applications stop. That shift matters because it is permanent. Budgets do not expand back just because prices fall later. The market that remains looks different. Fewer first-time buyers, fewer family purchases, more hesitation. The audience that built the industry no longer participates. That disappearance of buyers triggered consequences far beyond sales lots, reaching straight into manufacturing towns. Factory town fallout. When production slows, factories feel it first, but towns feel it longer. RV plants anchor entire regions. Pot suppliers, transport companies, diners, and service shops all depend on steady output. When shifts disappear, spending disappears with them. Temporary layoffs became permanent quietly. First came reduced hours, then extended furloughs, then job postings vanished. Payroll data from manufacturing counties shows income declines that ripple outward within weeks. The damage compounds. A laid-off worker delays home repairs. That hits contractors. A closed supplier cuts trucking routes. That affects fuels. None of this appears on industry sales charts, but it reshapes local economies. What makes this phase worse is timing. These towns expanded during the surge. Housing filled, rents rose, then income vanished. The adjustment is brutal and slow. This fallout is not isolated. It spreads. Once a factory town contracts, recovery takes years, and that damage feeds back into confidence across the entire market. That loss of confidence shows up next in resale behavior, where fear replaces optimism. Subscribe now to keep tracking this market as it unfolds. The next updates will show which dealers exit, where prices reset, and when risk eases. Staying subscribed means you see changes early before decisions get forced, and options narrow everywhere. Resale values collapse. Confidence? Resale pricing tells the truth faster than marketing ever does. Auction data shows recent RV models clearing at prices far below expectations. Units purchased 2 years ago are trading at discounts that once took a decade. That shocks owners and freezes buyers. Trade-in math collapses deals. When a dealer offers thousands less than expected, buyers hesitate. They delay upgrades. They walk away entirely. That hesitation spreads quickly. Listings sit longer. Sellers cut prices repeatedly. Each cut signals distress. Buyers learn to wait. Confidence erodes. The excitement that once drove impulse purchases disappears. This matters because resale confidence supports new sales. When owners believe they can exit without severe loss, they buy sooner. When that belief dies, the entire cycle stalls. Fear replaces enthusiasm. Waiting feels safer than acting. And when enough people wait, transactions dry up regardless of inventory. That stall forces the final reaction, where lenders decide the exposure is no longer worth it. Credit pulls the plug. Lenders move last, but when they move decisively. As inventory age and resale weaken, financing partners tightened terms. Credit limits shrank. Approval criteria hardened. Floor plan lines were reviewed and reduced. Dealers felt it immediately. With less credit available, fewer units could be carried. Some lenders exited the segment entirely, redirecting capital to lower risk assets. That contraction choked cash flow. Without credit, even discounted units become liabilities overnight. Dealers cannot stock depth or take risks on slow-moving models. Manufacturers cannot ship volume without financing support. The system slows to a crawl as cash replaces credit. At this stage, only drastic moves keep doors open. Inventory purges accelerate. Brand exits multiply. Store closures spread quietly. Survival replaces growth as the objective. Every decision narrows options. Expansion plans vanish. Hiring freezes lock in. What remains is defensive management, focused on staying solvent long enough for conditions to stabilize, knowing that recovery favors those who cut early rather than those who waited. Once credit retreats, recovery becomes difficult. Financing does not return quickly after trust cracks, and that final control locks in the damage already done, setting the stage for a market that will look very different going forward. The shakeout is locked in. Consolidation is no longer a theory. It is the only outcome left. Once margins vanish and credit tightens, weaker dealers disappear first because they lack scale, capital, and lender patience. Single-location stores carrying multiple brands face rising interest costs with no buffer. When sales stall, they burn cash faster than groups with shared inventory and centralized servicing. Closures happen quietly through lease non-renewals and inventory auctions, not headlines. Weaker brands follow for similar reasons. They rely on fragile dealer networks and thin parts pipelines. Once a few dealers walk, coverage gaps appear, warranty delays grow, buyers hesitate, volume drops further. Larger brands with deeper pockets can absorb losses longer, while smaller names cannot bridge the gap between production and demand. This process feeds on itself. As dealers consolidate, they choose fewer brands. As brands shrink, dealers drop them faster. By the time official filings appear, the decisions are already done. The timeline matters more than headlines suggest. With floor plan renewals approaching and model year transitions looming, pressure compounds quickly. Each renewal resets lender scrutiny, interest terms, and inventory limits. Dealers that fail reviews lose flexibility immediately. As calendars roll forward, the countdown accelerates toward 2026. When survival will no longer be optional for weaker operations. Nothing here reverses quickly. Consolidation removes choice, compresses timelines, and slows recovery. Fewer dealers mean fewer exit paths. Fewer brands mean fewer support options. That leans owners and dealers export longer, with less room to maneuver. As decisions become forced rather than strategic, dealer survival moves. Survival moves are already visible if you know where to look. Dealers cut inventory first, not prices. They reduce orders to the bare minimum needed to keep service bays active. New model years are delayed or skipped entirely. Lots look emptier by design, lowering interest exposure and storage expense. Many dealers pivot toward used units because acquisition costs are predictable and margins are clearer. Used RV pricing resets faster, tracks real demand, and does not depend on factory rebates that vanish overnight. Parts availability is usually better, and reconditioning costs are known before money changes hands. That stability matters when cash is tight and credit is watched closely. Brand purges follow quickly. Dealers rank manufacturers by warranty response times, parts speed, and resale performance. Brands that fail those tests lose floor space. Some disappear overnight, others fade slowly as remaining inventory sells without replacement during this market reset period. These moves are defensive, not opportunistic. They signal caution, not confidence. The calendar drives urgency. Floor plan renewals, lease dates, and insurance audits create hard deadlines. Miss one and options narrow. Time pressure intensifies because waiting carries cost. Every month a weak brand remains adds risk. Dealers act before numbers force them, because once lenders intervene, control disappears. This discipline fairs patience, punishes impulse, and quietly separates operations built for endurance from those for volume alone. Unrealistic post. Risk has changed, even for those who are bought. Warranty coverage moves less. And brands staff or parts pipeline spin. Plame slow, fuel stole, appears wheat. While being skittle, and got cost time and money. Friend failure risk no longer not. The manufacturer exits, support obligations often transfer imperfectly or not at all. Owners depend on third-party suppliers and independent shops. Parts get scarce, labor rates rise, resale drops sharply. Insurance values adjust as markets fall. Lower comparable sales reset payout baselines after losses, shrinking checks when claims hit. Gap coverage often fails to bridge the difference, leaving owners exposed to disparate higher premiums. What once felt protected becomes uncertain fast. These risks change behavior in predictable ways. Owners delay upgrades, cancel planned replacements, and avoid trade-ins that would lock losses in place. Spending on customization dries up because resale recovery looks unlikely. Confidence does not collapse loudly. It erodes quietly, month by month. As values slip, coverage weakens, and ownership feels heavier than expected during prolonged uncertain market cycles. The safer move in uncertain conditions is often patience. Waiting preserves options, allows pricing, inventory, and support networks to stabilize. Acting early can lock in losses that deepen later. None argues against ownership itself and argues for tinin awareness. the cost today includes more than price. It includes exposure to instability that did not exist before. Knowing that difference protects future decisions. Watching lender behavior and dealer exits over the next weeks reduces risk more than any advertised incentive available. The RV market after 2026. The RV market after 2026 will be smaller and stricter. Fewer brands will operate, fewer dealers will remain. Those that survive will focus on durability, service, and disciplined volume. Access choice disappears, standards rise, prices will adjust downward, but not evenly. Strong brands with stable networks hold value better. Weak names clear inventory aggressively or vanish. Buyers see clear gaps between dependable options and risky ones. Rules Titan lending remains selective. Inventory levels stay lean. Production aligns closer to real demand, not forecasts built on anomalies. That discipline reduces boom and bust cycles. For timing, the window matters. Short-term volatility favors patience. Watch for inventory resets, lender reentries, and support stabilization. Those signals matter more than sticker cuts. The guidance is simple. Avoid urgency and nor countdown sales. Watch what dealers do, not on ads promise. When lots stop taking shipments, that is truth. Favor models with proven parts availability, simple systems, and steady resale history. Walk past flashy upgrades that inflate repair costs. Wait for confirmation in auction prices, lender behavior, and inventory reductions before committing cash. The reset does not end RV trial, it reshapes it. This market will reward patience, punish speculation, and spoils rushed buyers. Understanding that shift keeps your money protected, while the next phase settles into something smaller, quieter, and more disciplined. And that's the real problem. This isn't just cheaper RVs. It's a dealer network under pressure. Lenders tightening and support getting thinner the longer this drags out. So, if you're shopping right now, don't get hypnotized by the discount sign. Watch the signals. Watch who's cutting inventory, who's dropping brands, and who's still standing. Now I want to hear from you. Are you seeing bigger discounts where you live? And do you think dealers make it to 2026? Drop a comment. Like if this helped you read the market clearer, and subscribe.